Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Welcome, everyone, to this episode of the Expansive CEO podcast. I'm your host, Hannah Chapman, and this is another Investment Friday. We are recording on Thursday, August 22nd. This will come out on Friday, August 23rd is when you'll be hearing it. And I am here with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies. Brad, we just were in the middle of an awesome conversation. We're like, wait a second, we should probably start recording at some point, right? So
yes,
take it away.
Well, we were talking a little bit of, I think we got started in the conversation about buybacks, right?
Mm-hmm.
We hear a lot about stock buybacks where companies are doing pretty well. They're earning some more profits. And then instead of reinvesting in the business, maybe it's a little bit more of a mature business. They don't need that level of reinvestment. And let's say they have a small dividend. They fund that dividend for the year. What else do they do? Pay down debt or buy back some stock. Well, oftentimes what you'll see is when the stock price of those companies is down, like they've had a really terrible year, they've declined in price, and now they're pretty cheap. They're pretty inexpensive. Management and board of directors oftentimes will buy their own stock with that excess cash flow. And what that does is it reduces the number of shares on the market. And so when you reduce the number of shares on the market, your market value, the price of your shares come up to make your market value the same. And so some very famous companies have done this. Apple has bought back so much stock in the past 10 to 15 years that a lot of the price increase that they've had over the past couple of years is due to the fact that they have so many fewer shares outstanding relative to what they did many, many years ago, because they just repurchased it all back because of the cash they had. And so what we did is I actually sorted through, and I'm going to share my screen really quickly.
Yeah, so if you're listening and you're just hearing, we're going to talk through what we're seeing, but this would be a great one if you want to head over to YouTube, to the Expansive CEO YouTube channel and actually watch.
Yeah, so we'll walk you through this verbally, but if you want, you can always go to YouTube to view it. What I did is I took the constituent companies of the S&P 500. I sorted them by a shareholder yield. Shareholder yield is a combination, or it's a sum of the net buyback yield and the dividend yield. So it's basically all the cash that the company is giving out of their profits to shareholders, okay? And you can see, the top one for the past 12 months has been General Motors. General Motors stock hasn't done fantastic. It's been pretty chunky. But they've been repurchasing 20 some odd percent. Okay, so that's a lot. They're allocating a lot of money to repurchasing their shares. GM has a lot of shares outstanding. So as they shrink that, they're going to grow their price per share. They have a small dividend. And so the sum of those, 23%. So that's essentially how much money you're getting versus the stock price. You're earning 23% on those shares. Now, whether the price immediately reflects that or not, that remains to be seen. But again, it goes towards that value type component. So 23% was the high. If we sort the other way, the lowest, you're going to have some that are going into debt. Net buyback yield is negative, which means they were issuing more shares than they bought back. So now they are diluting the current shareholders. And so you can see Welltower symbol WELL, again, issued 12% more in shares, 2% dividend yield, so that it was a negative 10% shareholder yield. And there's a lot in between, obviously, but again, it's these notions of providing cash back to the owners. Okay. Now, one of the things I want to talk about is who are the owners of these companies. So you had mentioned Robert Reich had a video on TikTok in which he goes over kind of price gouging and price fixing and how corporations are making a ton of money, and they are. Corporations are making lots and lots and lots of profits right now on an absolute basis, because as inflation grows, the value of everything grows, the price of everything grows, right? So nominally, corporations are making a tremendous dollar value of money. But if you look at it on a profit margin basis, okay, it's a little more tame than what he was probably indicating. But he had some good points. So he said food prices were very, very high, and he said they're going to do some things legislatively to look at whether there's price gouging going on in the food supply chain. Personally, I've looked at a number of companies, and their margins are higher than pre-pandemic, but not much higher. You and I talked about, and I'll show you really quick, everybody. If I can find Albertsons really quick. Yeah, so this is Albertsons. So Albertsons here this is the price of the stock right here. You can see it hit pretty high valuation of 30s, and it's kind of declined ever since. It kind of stayed low. Well, the second indicator below here is their profit margin. So you can see that, during the 21, 22, their profit margin expanded, went up a little. But since that time, it's kind of been the same and actually in a downward trend. And their current profit margin is 1.41%. So what does that mean? It means for every dollar that Albertsons brings in revenue, their profit is 1.4 cents. That's it, 1.4 cents. And you can see that basically it's break even. And in 2018, there's a lot of negative here. So that, their average is just barely positive for profit margin. So I think your comment was, what a terrible business model. Absolutely.
Yeah. You asked if someone came to you and their business made 1.4% profit, what would you say? I was like, that's a rough business model to have to maintain at 1.4% profit, right? But
yeah.
And I wanted to mention too, since we've got listeners in different parts of the country and around the world, Albertsons is, I think, the second largest grocery chain in the United States.
Correct. But you're right. Mostly in the West Coast.
Yes. Yeah. Mostly West Coast. And then Kroger is one of the largest grocery chains in the United States. Though I think Walmart is up there as well.
Yeah.
Walmart might actually be the first, and then Kroger, then Albertsons.
Yeah, I think that's right. And so right now, Kroger has made an offer to purchase Albertsons at, it's like $27, $28 a share, but there's also a special dividend on top of that, which makes it in the low 30s somewhere. But the Justice Department is looking at anti-competitive, whether that combination would be anti-competitive. And if it would be, what does Kroger and Albertsons need to do to overcome that hurdle of anti-competitiveness? I think it'll eventually go through, simply because, like you said, Walmart is one of the largest, if not the largest, food purveyor or grocer in the country, and they need to be able to compete on that basis. But one of the things, let me give you a little plug for grocery business. The 1.4% also makes sense when you're doing hundreds of billions of dollars a year in revenue,
Right.
right? So the dollar amount is huge because the revenue, I mean,
The
think of all
volume.
the, everybody's going to a grocery store once or twice a week, you know, oftentimes way more than that, but I mean, at least once a week. So there's a lot of revenue coming in, which is why it's so competitive of a business. But again, not really too much evidence of price gouging the way that Robert Reich at least implied.
Hmm.
Second thing he talked about was oil prices. Again, if you look at the profit margins
Oh, this
on
one
Chevron, go
is
ahead.
this one Chevron, or that one is
Oh, sorry, this is
Maine,
Maine.
right? Which is also like part of the grocery, right? Because we're
Yep.
talking about eggs. Everyone, well, not maybe not everyone, but a lot of people might remember the spike in egg prices.
Yes, because they've been probably the most outside of real high-end beef. I mean, eggs are probably the one that most people use. And so it's like, whoa, that went up a lot. And to be fair, I eat a lot of eggs per week. And I even noticed I was like, that's not good.
Right,
That's not good.
right.
But again, there's a couple of things to notice here. You see this massive increase, okay?
In
And you're right.
2023,
Yeah,
2023.
2023, big time spike in their profit margins. Okay. So high prices. So inflation was part of that. Okay. But you've noticed it's come off since then. Part of this is due to the fact that they had to cull their herd, excuse me, cull their flock of birds because of some sicknesses that had come in, and they had to kill a lot of egg laying hens. And when you do that, you have to get some more chicks. You have to grow them up into egg layers. And that's kind of what happened during this time. But as you see, this is declining, still above the average. Okay. But you'll notice this average has a lot of volatility in it, or I should say around the average, there's a lot of volatility. And I would
Hmm.
expect this trend to come back as a more cyclical, as more cyclicality comes in. This, I think this is a aberration that, 5 years from now, we'll look back and go, yeah, that excessive margin was an aberration. Okay.
Yeah. And for
Um,
people listening, it's right now, it had gone up. So in 2023, when we said there was a spike in the profit margin, it's up around
22.
25%.
Yeah. Yeah. Roughly
Yeah.
20 to 25.
Right. So it's up around there. And the average, the long-term average is 7.4% profit margin.
Yep.
And so when we look at that, you can see that disparity of like that's where we felt it as consumers. We felt that, if we're normally my family would buy free range eggs, and so they went from 3.50 $4, for a carton to $7 or $8 a carton. And then they've backed down a little bit from that. But even on this graph here, you can see there are years where they're negative. They have negative profit. Means they're technically losing money for some reason, throughout. And so, Brad, to your point, you're talking about the cyclicality of the market, which is what we're more used to seeing, especially with food prices, I think. That things that they cycle.
Yep.
They cycle more rather than even this, if you're looking at the graph, this kind of prolonged period of higher prices. I think consumers are actually feeling that. They're like, we're used to the cyclicality. And so when it stays high for longer, that's where we're like, when are these prices going to shift? When are prices coming down?
Yeah.
We feel it.
When's the supply going to come online? Right.
Right.
Because what excess profits do is it encourages competitors. Right. And
Hmm.
so for locally, I know my next door neighbor, she started, she bought 6 to 7 hens and has started laying eggs next door. And so I get a lot of my eggs from her. One, because I know they're grass fed and they're natural and all that. And two, it's because egg prices are so high. And she was like, well, I eat a ton of eggs, herself, her and her husband do. And so I was like, yeah, that's a great idea. You do it on your property and I'll buy them from you. So that said, it's still above the average. The profit margin's around 11% right now. So again, that's above the average. But my guess is as supply comes back online, as they grow their flock some more, you'll see egg prices start to moderate more to what we're more used to. But again, price gouging, I mean, Calm itself, so Cal-Maine is the company's name, is the largest egg producer in the country. And again, their net buyback yield is actually pretty minimal. So I don't see a tremendous amount of profits being rolled back to stockholders per se. And then the third thing he talked about was real estate, the prices of real estate staying high. And this one, I think he does have a valid concern. And you and I have talked about this a lot.
Yeah.
And so if everybody wants to focus their eyes on the mid, in fact, I'm going to get rid of the price just so we only have two indicators to look at. So the top chart here is the profit margin for Mid-America apartment communities. So this is a company that buys massive amounts of apartments. They build them, they own them, they operate them, and they earn rents from them. And you can see that the average profit margin is around 15%. Solid. That's a very good number over a couple market cycles. And you can see earlier in the decades, it was much lower than 15%. And then around the mid 2012,
Maybe 12.
let's say 2012, 2013, you started to see a secular trend up in their profit margin. Okay. So if you remember back during that time, we had extremely inexpensive financing, which real estate is very, very reliant upon. But also there's something else that went on. You had large communities, large investors like this coming into the real estate market to buying single family homes. And it became a phenomenon where it became very, very difficult to compete, because you'd go to buy a house and all of a sudden they'd be like, well, if you have a contingency, we really can't do that. So why don't you just sell your house and then you can buy a new house? Because we have a full cash buyer over here who's going to pay 20% more than listing for all cash within 30 days. Yep. And that story was replicated nationwide.
Yep, that happened to me and my husband when we were moving back to Arizona in 2013. We were looking to buy a house. We rented for a little bit. We were looking, trying to buy a house. It happened to us multiple times in that lower, I would say like $150,000 or less range. It's like, yeah, you got outbid by a cash buyer.
Yeah, absolutely. Because it's these companies that were getting involved who want to rent to you, to couples like you. They want to buy the house for $150,000 and rent it out for $1,200 to $1,500 a month. And then because these house prices are going up over time, they can increase those rents pretty aggressively. And that's what Robert Reich was talking about. And to that extent, I would agree with him that legislatively something probably needs to be done, because in terms of the free market, real estate investors rely on a lot of the same resources, the same technology, the same market data providers. And so a lot of them all have the same information. And so if you know what all the rents around you are, and if they're going up because the cost of real estate in your area is going up, well, that means every landlord is going to start to increase rents even if it's at a slow pace, they're going to increase rents because no one wants to miss out. And they'll get to the point where people then start moving out, um, because the value proposition doesn't become as good. I do think that's a problem, and I think that's a problem for a lot of families who want to become owners of their own homes. I think it's crowding out a lot of new first-time home buyers.
Mhm.
And I think that is going to have to be a legislative relief as opposed to something that the market happen. Now, whether it's going to be subsidies for, starter homes, or, is it, are we going to subsidize the mortgage on a first-time home buyer like we used to with FHA? We still
Mm.
do a little bit with FHA, but FHA, is more to protect the bank as opposed to the borrower. So do we make special provisions for first-time home buyers to be able to participate in the market without crushing the existing real estate owners around, because there's a lot of families that own homes that don't
Yeah.
want to see their values impaired. So I think that's very fair for him to bring up. I don't know if the oil and the food price one holds too much water, even though, like I've written about in our past commentaries, food prices and oil prices as a percent of your income is actually pretty low, and it's actually hasn't been this low in a very, very long time for the average consumer in the US. We spend less on food and on gas than we have in a very, very long time. Now, what really sticks in the craw is most people eat out, and
Yeah.
eating out has become far more expensive. And
Yeah.
so it's like, because we spend so often on those two categories, we feel like it's in overall inflation is higher than it actually is. If you look at the whole panoply of services and goods that we buy across the economy. Now, one of the things that he implied was these excess profits being plowed back for shareholders is only benefiting certain people, a higher class, a richer class. And I'm going to push back on him on that because I think he's wrong.
Interesting.
So, and I'll give you an example. Avalon Bay, which is one of the symbols that he had up, AVB, it's a large real estate owner. How much do you think of their shares are owned by institutions?
Oh, I couldn't even guess on that one. I don't know.
Okay, 70 to 80%.
Okay. That's a
And
lot.
that's pretty typical. That's pretty typical of a large company. Okay. So 70 to 80%. Institutions. Now I'm going to define institutions a little bit because it's a nebulous term in the investment markets. We always say there's a retail, which is individuals, and then there's institution, which seemingly is not individuals, right? Well, all institutions is groups of individuals. So for example, a 401k, that is a institutional investor, okay? But it's run by individuals. Each individual person has their own account and they run that however they want, right? But usually they're investing in an exchange traded fund or a mutual fund. Those are institutional investors, okay? So then you take other institutions like pension funds, same thing. They have beneficiaries that are all individuals,
Hmm.
okay? There are also other ways that individuals participate in these areas. Now, does it exclude some people? Absolutely. If you don't have a 401k, if you don't have any investments whatsoever outside of maybe a small savings account, you are missing out. That is, and it's terrible. It's not good, but you're missing out on the wealth creation going on in the United States or in the world, really, but in the United States specifically. Um, is there a way for us to include everybody? Well, that's an age-old question that you asked me. Okay.
I did.
And
I
you did.
did. That was my question and I want to share this because this is the question that I tend to hold on to just in general. As I look at the economy, as I look at, any of the data that we see, it's really like, can we have conscious capitalism that allows for growth across the whole spectrum of Americans, of people around the world? Can we actually have literally conscious capitalism that allows people to innovate, create new ideas, to benefit from those ideas and from the work that they do, while also uplifting more than just the CEOs, like the top 0.1% of a population, right? And everyone else is just working to get by. That's the question that I consistently come back to, is how do we create a more conscious, inclusive example of capitalism that can actually be good for everyone? Because I think the system we have right now does heavily skew towards the top, right? It's just the weights. It's like the hand is on the scale so heavily on the side of the wealthy, or to your point, wealthy being literally anyone with access to stocks, investments, pensions, 401ks. If we are in those categories, which I'm putting you and I in that bucket,
Oh, yeah, for sure.
right? Absolutely. There's no doubt about that. There are, I would guess, hundreds of millions of Americans, just Americans, and then around the globe, right? If we include the billions of people, but just in America, the hundreds of millions of Americans who have none of that, who don't experience, like you're saying, like when the stock market goes up, they're like, great, I don't have anything that ties to that technically, to participate in that.
Or even
Uh,
just buying a CD where you can
right.
earn
Yeah.
5%, right? I mean, your
Right.
money making money for you.
Right.
There's a division between people living paycheck to paycheck and people who can save a little bit and even just put it into a savings account where they get a little bit of something where their money is making money for them, whether it's a small amount or if you put it in stocks, a larger amount over a long period of time. Um, is there a way to do that? Yes. Um, but I think it has to rely on people. Like, so capitalism, like if you had a system, and I'll give you an example. So I worked for a grocery company growing up. It was a small little grocery chain called Rosars out of Spokane, Washington. It was fantastic. Met some of the most wonderful people in the world there. Loved every minute of it. Um, Rosars decided to sell. Okay. And they decided to sell and to liquidate. And what they did was they sold it to an ESOP. Now, for those who don't know what an ESOP, it's an employee stock ownership plan where all employees have a certain percent of ownership in the company they work for. Okay. That is one of the ways in which conscious capitalism can be implemented.
Hmm.
Because yes, the CEO had a higher percent of ownership than the courtesy clerk who's bagging your groceries. Okay. That's fine. But
Right.
at least the courtesy clerk who's bagging your groceries had some. So if the profits go up, the value of that stock goes up, that individual, that courtesy clerk benefits as well.
Right.
And so that's one of the models. Similarly, I think the mutual form of organization also implies that type of thing where for those who don't know, a mutual insurance company, and Bob, don't kill me on this, okay? So don't, I know, I don't want
There.
anybody, I don't want anybody from the insurance world to take offense at this. I'm just explaining using an insurance company as an example. But a mutual insurance company also puts the client on the same side of the table as the insurance company, because everybody wants to make money, right? Everybody wants to cover the costs of doing a business and produce a little bit more so that they can invest in the investment side and returns can be generated. So it all puts them on the same side of the table, and policy owners benefit the same with the company. But I think what has to happen, and I think in today's world, we rely on so few. Well, I should say, in today's world, information is so available
Mhm.
that the problem becomes it becomes a self-fulfilling prophecy. For example, whenever a board of directors is going to hire a CEO to run a company in a particular industry, they hire the same, basically a small group of consultants do that type of work. So they
Right.
hire the same consultants as their competitor, and they say, hey, what kind of compensation program should we offer our new CEO coming in? And because this consultant has also worked with their competitors, that consultant comes back and says, you have to pay XYZ amount of dollars to get a good CEO. Well, that's a self-fulfilling prophecy, because the same group of consultants funnel the same information to all of the companies in that industry. And I don't know if it's a type of collusion per se, but I do think it's an informational symmetry, which then creates this false sense of floor, like this false certitude. And who that has benefited the most, as you mentioned before, has been the C-suite, the chief investment officer or the chief finance officers, the chief executive officers, the presidents of companies. Those top managers have benefited far, far more from using those consultants than the entry level individual or just the frontline worker. Um,
Well, one of the things I wanted to mention here is that with that, because putting that with transparency, right, or information availability, it's really, really interesting because I think it's been happening for a while, right? This isn't necessarily new. We know
no,
CEO salaries have been going up since about the 70s, um, which there were different things that happened back then. We could talk about in another episode, actually, right? About why CEO salaries started going up at that time. But they've been increasing and increasing and increasing at a higher and higher rate. And people didn't necessarily, like the people, rank and file employees didn't necessarily know that for a long time. And so this information transparency that we're seeing now, we can think about people at companies where, for years they were told you're not allowed to talk about your salary with your coworkers. You're not allowed to talk about these things. You'll get written up, you'll get fired. And now we're seeing in some states, legislation being passed that employers are not allowed to. And in fact, they have to post salary transparency. And so as we see more transparent, as we understand, like the spread, how much CEOs are being paid, and there's more information transparency there, we're also seeing people clamor for information transparency in the hiring process and, with their coworkers. Um, they want to know, okay, well, like we know XYZ CEO is being paid $125 million a year, and yet we're being told that, due to budget reasons, we can't hire more people, or due to budget reasons, we're actually laying off team members. And those two, there's a cognitive dissonance there because we know, we know that you don't need quote unquote need $125 million per year to live. And yet it's not the profitability of the company itself isn't filtering down all the way through the rank and file. Um, and so, yeah, that information transparency, I feel like it started something that now, oh, wait, now we have more information. Now we're going to ask for more accountability, I think is actually not just transparency, but accountability to, how are we going to create spaces where people want to stay, where people feel valued, where people are invested in the success of a company, because that's what we need. And how one of the ways I love that you brought up ESOPs, because I think that's a huge, huge way that companies can, especially smaller companies, right, that uh, have that ability to create an ESOP where every single employee benefits. The company profits, they profit.
Yeah, I mean, if you go back, there's certain industries that are much better than others in terms of this. The tech industry has been by far probably the best example of creating wealth among everyone.
Mhm.
I mean, a lot of stock options are handed out to everyone.
Yeah.
Uh, Oftentimes executive assistants have far more stock options than entry level programmers and marketing people. So it's an interesting dynamic. And that has been one industry which has impacted. I mean, if you look at the areas where tech historically has been located, Boston, San Jose, um, now Utah, Austin, a couple of other, hubs around the country, those areas, because the wealth has been spread out, have
Mhm.
benefited far more than if it was just on the top end.
Yeah.
I mean, I think this goes back to the Microsoft effect in Seattle, back in the 80s and 90s and 2000s, and well, even till today, but it was really explosive during the 80s when, you had people get jobs at Microsoft. In fact, I had two friends who were PE teachers from middle school who quit their jobs, became marketing agents for Microsoft in the early 80s, and retired multimillionaires because they had stock options and those options paid off for them and
Mhm.
in spades. And so that to me we went down that track. I think tech did a much better job. I think finance started to do that, but then has retrenched over the last 10 years in terms of giving out options as the banks have gotten bigger. I think
Mhm.
they do less and less of that, unless you're one of the top managers. So again, it's that bifurcation of who's benefiting versus others. Um, but there can always do better. Yeah, there can always be better options. I think it's possible to have conscious capitalism. It's particularly what I practice because I think when people get to a certain level of wealth, it's behooving upon them to give back
Mhm.
via philanthropic efforts or just to serve mankind in general. I think that's one of my core values is to serve those around me, right? So I think we need more larger, better examples of that. I think the antithesis of that would probably be an Elon Musk that has pilloried people in the press for giving away money to charities. You
Yeah.
know, I think that is a massive and a very important um, function that very, very successful billionaires should do. Um, I know, I mean, obviously, Warren Buffett and Bill Gates are probably the two most famous philanthropic billionaires who have made massive amounts of money and who are virtually saying they're going to give away almost all of it upon their deaths, and they're funding other charitable things. Now,
Mhm.
you know, depending, you may like them or dislike them. All I'm saying is that they've given a lot of money away.
That and
Um,
you see that too with Melinda Gates as well.
yeah, yep,
Mackenzie Scott
yep.
has
Mackenzie's
almost.
been
I've
she's
written
been
about her. Yeah, I've written about her in Forbes that like she's redefining what it means to be a billionaire. Redefining what it means to like really truly support things that can help society. Things like giving, uh historically black colleges and universities the biggest endowments they've ever received that will help them, continue their legacies for hopefully forever. Things like that. Even Taylor Swift, giving the biggest donations food pantries have ever received in every stop that her tour takes, right? Or another example with her is giving her truck drivers $100,000 bonuses, like literally doubling their pay for the year for being on tour with her, for being part of this literally billions plus economic engine that is the Eras tour.
yeah.
That to me screams, I care about the people who are around me. She is wealthy. There's no doubt about that. And she's taking that wealth and consciously giving it to the people who are helping her along the way and to the communities that are welcoming her and her tour. And I think those are some really good examples of how those things can coexist, right? You can create amazing amounts of value for people,
No,
whether that.
absolutely, absolutely. And I think I honestly think that's one of the societal norms that, I mean, if you go back to all of the families in the Industrial Revolution that made a significant amount of money, you know, you have those foundations alive today, which are
Mhm.
still giving money to charitable interests and those things to help further society along the goal of helping everybody. Um, so I think it has to be a choice. I think it has to be something within that individual to make that choice. Um, if Elon, you know, eventually he passes away and he has, I don't know, he's the first trillionaire on earth.
Right.
Um, I mean, good for him, knock himself out. He's had a lot of success. Um, but I think that other billionaires, other very, very successful people will make the choice. And that's where conscious capitalism comes in, where, once you get more than what you need to live and to take care of your family, you should look to the outer community to find out how you can help those that are less fortunate than yourself.
Well, I love this. I love where this conversation went. And I think for most of the listeners of this podcast, um, a lot of people that I know personally or who reach out to me and tell me how, something that we've talked about sparked an idea or, helped them in some way. A lot of the people that we're talking to are beneficiaries of the growth in the stock market. Most of them have investments and 401ks and businesses of their own, right? Like that's who we're mostly talking to here. And so sometimes that looks like, okay, well, how do I help my kids benefit as well? How do I introduce these concepts, further beyond me because I'm taking advantage as much as I can, or I'm learning how, or I'm like literally listening to this podcast right now so I can learn more, right? That kind of thing. Um, and so I think that's a beautiful invitation, if you do have people in your life that you want to learn, like there are ways we can choose ways even in investing. There are investments that you can choose, like if you want to be a conscious investor as well, there are plenty of ways that you can choose to do that and be mindful of the companies that you invest in. There are just so many ways that you can go about this and be you know part of the growth that is beyond just what you can do with your time, so that your money is making money, that you're not relying on your time, just your time to make money, because that's
Exactly.
where we all burn out.
Yes, that's where once we stop working, it also stops. So
Right. Right, exactly. Either work yourself to death, or you just, yeah, you burn yourself out and you're like, "Oh, I can't do that. I have to find a way
you
to."
know, and that goes to a good point is, it's only been 100 years that the general populace in the United States could participate in these types of investments. Um, I mean, if you think back, I believe 1929 was the first mutual fund creation. Um, so if you go back to 1924, most people were working and they were not investing. They were not participating in I think the most they may have owned was maybe a farm or a small store.
Mhm.
Um, and did that have value? Probably, but we don't, it wasn't as much as investing in a conglomerate, maybe. So it's really a very recent in history, a very recent phenomenon that the average person can participate if they choose to do so. And the wealth being created that from that. Whereas in prior centuries, it was truly only the royal and the feudal classes that were able to participate, and they owned everything, and everybody else was renting from them as serfs and as renters and farming small little plots that they rented from their local lord, And so I think we're in a unique situation with the United States and also around the globe, but really the United States, where if you're an average investor, you can start to benefit from these things.
Right. And we don't wanna go back. We're not going back. We're not going back to feudalism or rent, where we rent everything, um, and not own, I think that's maybe part of, I don't know if it's part of the American dream necessarily, but this sense of ownership over your life, sense of ownership over what you choose to do with your time, where you want to live, all of that. Um, I think we have been very conditioned in the US, especially, to, like, that's part of what we're here to do, is to, there's a certain individuality um that we embrace and embody, but at the same time, okay, where do we move from, like, I am independent to I am interdependent. And I think there's that's where kind of that crux lies too. That conscious capitalism implies interdependence. Uh,
Absolutely.
and it's a beautiful thing. So I love this. I thought this was a great conversation. Thank you, Brad, for
You're welcome.
humoring my big questions about stock
You're welcome.
buybacks and conscious capitalism. Um, and as always, if this has sparked anything for you, please let us know. Reach out, send us your questions. You can always send me questions for the podcast at Hannah, HANNAH, at expansiveceo.com. And Brad, how can people get a hold of you?
You can get a hold of me at Brad Haines, or excuse
Uh-uh.
me, that's wrong. B Haines, BHAINES at juncturewealth.com, or give us a call at our number 480-253-4100.
All right. Thanks for being here, Brad. We'll see you next time.
Thanks. Bye.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, at expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.